This short tutorial provides an introduction to the structure and terminology of the balance sheet. The balance sheet, also called Statement of Financial Position, is a snapshot of the financial status of an organization at a point in time. The balance sheet is prepared at the end of an accounting period. The balance sheet reflects the assets, liabilities, and equity of the company at a moment in time. There are two sides of the balance sheet. One side shows the assets that the company controls. The other side shows whether those assets are funded by liabilities or funded by owner's equity. An item can be classified as an asset if it meets the recognition criteria for an asset. Will the item result in a probable future economic benefit to the company? Is the item controlled by the company? And was there a past transaction that led to this control? The asset side of the balance sheet classifies assets as either current assets or non-current assets. An asset is classified as a current asset if the company expects to convert the asset to a cash inflow within 1 year. Examples of current assets are cash, accounts receivable, and inventory. An asset is classified as a non-current asset if the company does not expect to convert the asset to a cash inflow within a year. Examples of non-current assets are equipment and property. The other side of the balance sheet shows liabilities and owner's equity. An item can be classified as a liability if it meets the recognition criteria for a liability. The recognition criteria are: will the item result in a probable future economic outflow from the company? Is there a present obligation to transfer this economic outflow? And was there a past transaction that led to this present obligation? Liabilities are classified as either current liabilities or non-current liabilities. An item is classified as a current liability if the company expects to meet the obligation within 12 months. An item is classified as a non-current liability if the company doesn't expect to meet the obligation for more than 12 months. An item can be classified as owner's equity if it meets the recognition criteria. Owner's equity comprises shares issued to owners and investors as well as accumulated retained earnings. The total assets on the company balance sheet must equal the total liabilities and owner's equity. This is because the assets the company controls can only come from one of two sources. Either the company borrowed to buy the assets or the company bought the assets with its own equity.